Is this a good company to invest in? What is the business worth? And how do you make sure you are not overpaying for the stock? Hi, welcome to the Dutch Value Investor channel. And in this video, I will show you how to analyze a company and how to value its stock. So you can create your own watch list with companies you understand and you know why and when to buy them. In order to do this, I will be using a 4-step process to analyze the strength of the business, the strength of the management, and the calculation of the intrinsic value of the company. Because only if you're confident with your own story, you will be able to make rational decisions and know when or when not to buy the company's stock. So without further ado, let's go to the first step. Before you start going through the financials and plow your way through the balance sheets, 10K forms, and quarterly presentations, it is important to have at least a basic understanding of the company and the environment in which the company competes. How does the company generate revenue? Who are its competitors? What are obvious risks? Understanding the business model and the company's environment makes it easier to evaluate potential risks. For example, you know nothing about the chip manufacturing industry, but you decided to invest in a chip-making company because you heard at a party that this company produces the best chips in the world. Now the next month its competitor comes out with the new Megatera double-layer semi-nuclear fusion chip that they say will change the industry and will leave your company biting the dust. Now, is this true? Will this change the industry, and is the company you invested in old news? And were the chips your company produced even the best chips in the world in the first place? Or is it just big talk, and are they just hyping up their new product? Having at least basic knowledge of the company and its environment will give you greater confidence in your own assessment of the company and may prevent you from making emotional decisions when Mr. Market gets a little moody or overly cheerful. Looking at companies closely associated with your work, hobbies, and interests is always a good way to start. It is not necessary to be an expert in the industry, but the more you know, the better you can make assumptions for the future. You might be surprised by what you already know about a company. The perfect company to invest in would be a company that will never cease to exist and keeps growing year over year. But such a company does probably not exist. But what you can look for is a company with a high probability of being around and maintaining a healthy growth rate for at least the next 10 to 20 years. For a company to keep being relevant and maintaining a growth trajectory for the next 10 to 20 years, it needs some kind of edge over the competition. Some kind of competitive advantage or so-called moat that protects the company from competitors taking over the business. A moat can be something like a brand name, a secret or patent, or a strong network. Having basic knowledge about the company will help you identify the type of moat. Companies with wide and strong moats will also have the financials to back it up. A company with a moat will have relatively consistent and high financial numbers over long periods of time. Now the numbers you are looking for are the equity growth, earnings growth, cash from operations growth, and sales or revenue growth over the last 5 to 10 years. You are looking for companies that will have at least an average growth above the 10% in order to confirm the presence of a moat. With this confirmation, you can make a reasonably educated guess about what kind of growth the company can maintain well into the future. Now let's have a look at an example of a company with a moat and a company which probably doesn't have a moat, or the moat has been breached. Let's stay in the chip manufacturing industry and look at the first example. These are the growth rates of NVIDIA. The growth rates are the average growth year over year from 2012 till 2022. As you can see, the average growth of the equity, earnings per share, cash from operations, and revenue is 24.98% year over year for the last 10 years and are even getting better for the 5 and 3-year average. Well above the 10% you are looking for. For this company, you can probably assume it has a strong moat and it will stay in business for the foreseeable future. Now let's look at another chip manufacturing company, Intel. Same industry, completely different story. Although there is still a small growth year over year, if you look at the last 10 years, the numbers are getting progressively worse. For this company, the financials do not confirm the presence of a strong and wide moat. It might be there, but it also might be breached by the competition. As a value investor, you need better financials in order to make an educated guess for the future, or else it will be just hoping and wishing. Now that you can assess the strength of the business, let's have a look at how to assess the strength of the management. Because having a strong business model is not always enough. There are multiple ways management can screw it up big time, at least for you as an investor in the company. Before you think you need to know the CEO and all the members of the management team personally in order to evaluate if they are competent enough, there are some key indicators to look out for. The first one is ROIC, or return on invested capital. Meaning, what is the rate of return on the money being invested into the company? For example, if the CEO is buying other businesses for the sole purpose of growing his empire and generating lots of sales but with bad returns, it will show up in the ROIC. If that is the case, you can better take your money elsewhere, where it will be put to work more efficiently. A healthy ROIC is above the 10% on average over the last 5 to 10 years. A second metric to look at is long-term debt versus free cash flow. This one is quite simple. It is hard for a business to go bankrupt if they have no debt. So no debt is ideal. High debt can become a real problem if it needs to be refinanced against higher interest rates, especially when the company experiences a rough patch at the same time. But a little debt is not a problem as long as it can be paid off quite easily, preferably within 3 years using free cash flow. You can use the trailing 12 months free cash flow as long as it is in line with the average of the last 3 years. High debt could be a warning sign of bad management or financial troubles lurking on the horizon. The third and last metric to look at is outstanding shares, and especially the dilution of outstanding shares. This metric is really important for a shareholder in a company, and it gives you an idea of how the CEO is treating the company's shareholders. Giving out shares instead of taking on debt might be good for the business, but for you as a shareholder it might be a silent killer and can greatly reduce your overall results. Here is an example of yet another chip manufacturing company, AMD, where management is not so kind to shareholders. Although earnings are about 4 times as high in 4 years, earnings on a per-share basis are only 2.5 times as high because of almost 50% share dilution. What kind of share dilution you are willing to accept from the management depends on your desired investment returns. But it is important to keep an eye out and be cautious of dilution. For you as an investor, it is better that the company is buying back its own shares. At least, when management buys back its own shares at the correct time. Buying back shares when the stock price is at an all-time high can be bad money allocation as well. Once you are confident you understand the business and its financials and you feel comfortable with the management team and how they run the company, you can then start to put a reasonable price tag on their stock. And this is how to do it. There are 2 ways to determine the intrinsic value of a company, either through their earnings or their free cash flow. Both methods can be used separately, but it is even better when they are used together to get an even clearer image of the true intrinsic value. First, let's start with the intrinsic value based on earnings. For this calculation, we need the trailing 12 months earnings per share or the average earnings per share over the last 3 years. This depends a bit on the timing when you are making this calculation. If the company has an exceptionally good or bad year, which is most likely not representative for the coming years, then you are probably better off using the 3-year average earnings per share. This gives you a more smoothed off result. Second, we need the future growth rate of the company. So at what rate will the company grow year over year for the next 5 to 10 years? Now for this, you do not want to solely depend on the estimates of analysts, because they are not always right, and they will change their estimates quite often depending on the mood of the market. So you also want to use historical data to back it up. And here is where the 10-year average moat growth can be used. You can now use the average of the moat growth and the analyst's estimates, or you can make your own educated guess based on these 2 numbers. The third number you need is the future price per earnings, commonly referred to as PE. Now this one can be a bit tricky, because when markets are really optimistic, PE levels can reach insane levels, and when markets are depressed, PE levels can get into the low single digits. The average PE of the S&P 500 over the last 20 years was around 16. Here is an overview of recommended PE ratio ranges coupled to the estimated growth rate you can use to determine a reasonable future PE ratio. The last number you need to determine is your required rate of return. This is the percentage of profit you would like to make year after year. Now this also determines your margin of safety. A higher required rate of return means a larger margin of safety. Taking into consideration that the average rate of return on the S&P 500 for the last 20 years is around 10%, you probably want to increase this return to at least 12.5 to 15% to make it worth investing in individual stocks, instead of investing in an index fund or ETF. Now that you have determined all the numbers, you can use the following formula to calculate the intrinsic value of the company on a per-share basis. Here is an example calculation of chipmaker NVIDIA. EPS is $2.24. Future growth rate is 20%. Future PE is 21 and required rate of return is 15%. Giving NVIDIA a value of $58 per share based on earnings. The second way to determine the intrinsic value of a company is a calculation based on the free cash flow that the business generates. This calculation is a bit more straightforward and has less variables. For this calculation, you take either the trailing 12 months or the 3-year average free cash flow, depending on the historical and recent performance of the business. You grow this free cash flow with the same growth rate as the earnings for the next 8 years. 8 years is used because this is the approximate time frame an average investor seeks to earn back his initial investment. You add up these free cash flows and add the equity which can be found on the balance sheet. You divide the outcome by the number of outstanding shares and end up with an intrinsic value per share. If you compare the earnings calculation to the free cash flow calculation and the two outcomes are in line, perfect. Your analysis is probably decent and the company has earnings and free cash flow that are in good balance. If the two outcomes are not in line, it is worth checking where this difference comes from. Does the company have exceptional high or low free cash flow? Based on this, it might be better to use one calculation method over the other. Here is an example calculation of the same company, but now using their free cash flow. Average free cash flow is $5,699 million. Future growth rate is 20%. Add the equity to the cash flows and divide by the outstanding shares. This gives NVIDIA a value of $56 per share. Now you know how to analyze a company and put a fair value on their stock. It is time to start analyzing and get your own watch list ready. All you have to do then is wait patiently and let Mr. Market put great companies on sale for you below your target price. Please leave a like or comment if this video helped you. I'd really appreciate it, and consider subscribing if you like to see more videos. Also, check out these videos for some great companies that might be interesting for you to put on your watch list. Thanks for watching and see you in the next video.